In today's episode, we're going to be talking about how to invest in opportunity zones. We're going to talk about when did the opportunity zone came up? Do you find an opportunity zone? What are the benefits associated with investing in opportunity zone? We're also going to be going over different situations where investing in opportunity zones may make financial sense just depending on your situation. And then we could also talk a little bit about due diligence and how to make sure that you're investing in the right opportunity zones. To help us with that, we have Lyndon Gray. He's a repeat guest. He's here with Atria Wealth Management. Welcome back to the show, Lyndon. How are you?
I'm well. Thanks for having me again, and always a pleasure to speak to your audience on these matters.
I love it. I'm so excited about this because obviously we get to share some wealth. So let's jump right into it. What is an opportunity zone? When did they come about? And what do opportunity zones accomplish?
Got it. So, opportunity zones came about because, or the legislation came about with Tim Scott from South Carolina, Republican, and Cory Booker, a Democrat from New Jersey. It was a bipartisan legislation. Both parties agreed that uh, they want to incentivize private sector dollars to move in a direction. And what better way to incentivize than to say, hey, if you do this, we're not going to tax you, we'll give you some tax benefits. Very similar to the municipal bond market. One way municipalities, cities, and governments raise capital, whether it's for educational purposes or to redo the 405 or to redo LAX, they issue tax free municipal bonds. And they say, if you buy these bonds, we're going to give you interest, and that interest is tax exempt. So that allows the wealthy and people with capital to say, yes, buy me 1 million of those bonds because I have this money in CDs earning taxable income. Buy me it, put it in the bonds, and I will get a tax-free return. So in essence, they took that chassis, if you will, and layered on top of it opportunity zones. So basically saying, if you seek out blighted areas and redevelop them and put capital into them, we will allow you to, when you sell that asset full cycle, we would allow you any gains from that to be totally tax free. So if 1 million turns into 2 million, that 2 million can hit your bank account and Uncle Sam gets no taxes, capital gain taxes. However, the legislation also says you can only put capital gains from sale of a business, sale of real estate, sale of intellectual property. You can only put capital gains into an opportunity zone fund to qualify. You just can't take money sitting in bank deposits and say, okay, I'm going to put it into that opportunity zone. And the other thing is the opportunity zones legislation through Congress came out in 2017 under the Trump administration. It was laying dormant in prior administrations, but when Trump came in, it gained some steam, and then the two heads came about in terms of the bipartisanship and realized this would be a good vehicle to put out there in the market. Came out in 2017, didn't really take the it didn't really take full speed until 2019 or so because they had to work out the particulars of the law. But the main crux of the legislation was on paper, and then they had to really work out the little fine points. So one of the fine points is the if you buy an asset for 1 million or 10 million or whatever, you have to spend the same capital that you bought it for in order for it to be considered a qualified opportunity zone transaction. So they wanted to weed out the people who would just buy a duplex in a blighted area and then put in new rugs and change some doors and spend 5 grand and then sell it X amount of years from now and make triple or whatever. And that's considered an opportunity zone transaction. So they wanted to weed that kind of transaction out. So what happens is when this law first came out, the mom and pop investor, developer saw it as an opportunity. But then when they really read the fine print in terms of, okay, if you take down this asset for a million, 2 million, you have to dump another 2 million on top of it to really make it have any teeth. So what happened is the institutional buyer, the big Cantor Fitzgerald, Inland, and the big deep pocketed buyers, they started coming in and gobbling up assets because they have the deep pockets to take down an asset for 10, 20 million or whatever it might be, tear it all down and build from the ground up and create an enormous amount of wealth. Prime example of that is student housing next to USC. If you drive down on Figueroa and I think you pass Adams, believe it or not, that area was considered an opportunity zone. People drive there today and they say, "My, it looks great." There's no way that's an opportunity zone. But how it became selected when the opportunity zone legislation came about, governors of each state had the authority to basically mark out what part of their state is deemed an opportunity zone. How did they do that? They looked at 10-year census. The census is taken every decade. So this law was passed in 2017. So they looked at 2010 census and basically carved out, okay, over here will be an opportunity zone, over there on the East Coast, et cetera. And so that's how the opportunity zone legislation was carved out. So that's why you might say, whoa, that area by USC doesn't seem like it's an opportunity zone. It's all built out. Well, it wasn't when you look at the 2010 census versus today. So that's why it became an opportunity zone. And there's no coincidence that you see newer properties going up along Figueroa and close to USC. A lot of multifamily apartment complexes. Inland, one of the companies I have access to in the DST 1031 world, has $100 million student housing facility there with rooftop pool, with bike racks, all the amenities, and it's a walking distance to the university, and it's all leased up. And so that's a little overlay of the opportunity zone and the legislation that brought it into place.
And you said it's only for people that are doing a 1031 exchange in order to take the full tax benefits of it?
No, an opportunity zone has nothing to do with the 1031 exchange. It's basically what I meant was it has to be capital gains, whether the sale of a business or the sale of a real estate. If some, it could be primary residence or sale of businesses because those two transactions are not eligible for a 1031. So they tend to seek out other tax deferral strategies, and opportunity zone makes sense. The 1031 situation, where it might come in handy, is if someone missed their deadline. Say they were looking for a property out there, the 45-day window crept up on them, and now they can't find something. So the money, it becomes fully taxable on the 46th day. However, with the opportunity zone legislation, you have 6 months after escrow closes to utilize an opportunity zone for tax deferral. And I should point out, tax deferral, you get tax deferral and then full tax exemption, providing the assets are there for at least a decade. The tax deferral is up until 2026. So 2026, and then you pay the tax in 2027 on that particular transaction. So how the big opportunity zone funds are looking to deal with that is
Structure.
as they build an asset up, you now have equity in that asset. And by 2026, they'll take some refi out and pass it on to the participants of the fund to help pay that tax bill, that bill that was deferred. So then when it stays in that fund and that student housing portfolio that I referred to earlier goes full cycle a decade from when they started it, they will then get whatever appreciation will be fully tax exempt on those dollars. So that's some of the nuances of it. So it can be utilized if you missed the deadline, if you fell out of escrow on a transaction, and you say, "Oh my, I'm going to get hit with taxes." You can utilize an opportunity zone. You don't have to use all the funds. You can say, "Okay, of this 800,000 or $1 million, let's put 250 in an opportunity zone fund. At least I can get some partial relief and have those dollars grow potentially tax exempt into the future." You also can utilize the opportunity zone legislation when it came out was very specific to blighted areas. And what has happened over the last many years, some places, like I said, the census was a decade ago. So some small spots in Beverly Hills or some areas that are swanky, quote unquote, still have a small sliver of an opportunity zone area, and some see that as kind of unfair. But yeah, some people kind of took advantage of the 2010 census to do that.
How can somebody use like a opportunity zone for like tax planning? Like meaning like let's say I'm 70, I've got some gains, I got some money that I want to grow for the next 10 years, and then at the end of 10 years I want to be able to sell that and not pay any taxes on that portion of it. How have you seen different clients utilize opportunity zones, in other words, as it
I've,
relates to tax planning, tax savings, etc.?
I've seen it done in a combination of ways. For instance, the straight take gains and shelter those gains and shift them over to an opportunity zone. I did that in 2020 during the height of the pandemic. You might recall a lot of the stay at home stocks kind of did great. Zoom, Roku, some of the internet type related names and so on rallied tremendously. Zoom became a $400 stock. Roku was a $400 stock. Um, um, what's the name? Moderna, the vaccine company, became a 400 something dollar stock. So those were quick gains that clients achieved in their portfolios. So what we did, we reallocated some of those dollars by taking those gains and say, let's park them into an opportunity zone fund. This particular client had young adult kids in college and so on. So it's conceivable to believe like a decade from now, they're going to want monies for a down payment on a home. So rather than waiting for that to happen and selling appreciated assets and paying taxes on that, we came up with a solution to address that future potential purchase by investing in an opportunity zone fund, and that goes for a cycle a decade when they would probably be 27, 28, maybe looking to buy their first home. Those dollars can then be utilized to buy an opportunity zone fund, excuse me, to buy their first home using the funds from an opportunity zone fund to do that. And all the while, you took some gains from those appreciated assets, where those assets currently in today's market are back down to very normal levels. They're not at the 400 plus anymore like they were back in 2020 when in the height of stay at home, shelter in place, and the vaccine situation. So that's one area.
So it's basically like a vehicle where if somebody wants to plan for like a lump takeout of money and they want to grow that money for the next 10 years tax free, it's basically a perfect opportunity for, like, let's say you're getting that situation where you have your kids that are eventually going to want a down payment, maybe a situation where you're looking to retire and take some chips off the table. It's basically helpful in those types of different situations, basically.
Indeed, it can augment a situation where you know you're going to have a pension 10 years from now, or you have to tap into your IRAs, but you have this gain from an asset or liquid stocks that you want to take and then just shelter it. And the fact that you would also diversify into real estate, where most people might not be able to take down a multifamily asset and do their own opportunity zone. They can piggyback off of a fund that basically allows them to gain the same benefits, just like the big institutional players will get.
Now, I know that the goal is like obviously there's two things, at least what I'm getting from this opportunity zone is that by 2026 they have to pay the taxes on whatever gains they put in there, and then they have to keep it in there for a minimum of 10 years. So the gains that you have, you don't get taxed on them now, you basically get taxed on them in 2026. um, have interest rate affected that business model at all, where they believe that they can get the investor back some money to pay taxes on that? Or do you see that being affected in any way, shape, or form? And then also, it sounds like for that reason, for a traditional like person, it may not, it may be better to do it in a fund than do it individually, basically, because if you do it individually, you have your money tied up, but then you need some money for taxes, and then it's tied up for 10 years basically. So it kind of and you have it tied up for 10 years, and then you have to invest the same amount that you purchased it for. You have to invest the same amount into renovating the asset or like building it down, so it can become very capital intensive basically.
That's true. Your point on the interest rates, yes. Interest rates, if they stay the same, it'll be a more expensive transaction to refi and pull equity out on these assets come 26, for clients to pay taxes in 27. However,
Mm-hmm.
these institutions, they certainly get the better pick of the litter, if you will, when it comes to financing because they're deep pocketed, and banks are easy or willing to lend on these assets. Sure, they won't be at the 3.5, 4% rate anymore like they were in pre-pandemic times. It'll probably be more 5 or 6 range. But in their eyes, they see that as a as a benefit to get some equity out and help the participants pay down that tax bill and then have future full tax exemption a decade from now.
So we did an episode on Delaware statutory trust, and one of the questions that I asked you on Delaware statutory trust is, how do you find the good opportunity zones? Are there good opportunity zone funds and other funds as well too? Like what type of advice do you give your client as to, okay, if you're going to do this opportunity zone fund, here's what to look for, here's how to underwrite it, here's how to see if it's a viable business model? Like what would you say in that
Yeah, I would
situation?
start first of all and ask yourself, whoever the fund is that you're looking at, do they have experience managing real estate assets, taking down assets, developing them, bringing them to market full cycle before this whole discussion of an opportunity zone? Or are they just new to this space and like the outline of the law,
Yeah.
and they're just getting into acquiring property and so on and so forth? So that's what I would ask, number one. If the answer is no, then I certainly would not um, feel at ease going in with someone who is just jumping on the quote unquote bandwagon because of the opportunity zone and seeking an opportunity to raise capital and put money in the ground and develop it and so on. So I look at seasoned players. Inland, for example, is a 56-year-old firm. Cantor Fitzgerald is a 75-year-old firm out of New York, major real estate player. And some others that are out there are large players. So I tend to stick with the more deep pocketed, well experienced. And a lot of times, these companies like Cantor, they don't, they're in the real estate space, But it's one thing to be in the real estate space as a landlord, but it's another to be in there as a developer, bringing dirt into a structure and creating equity. So they partnered with someone like Silverstein Properties. If you look up Silverstein Properties, you'll see they are a monster when it comes to the breadth, their existence, the type of properties they have across the U.S. They're the ones who own the New York Port Authority. They bought that structure, that property before 9/11 from the New York Port Authority, and then they were the ones to redevelop it after the 9/11 catastrophe and bring it back to where it's at today. And they own other trophy assets. As a matter of fact, they came into the LA market during the height of the pandemic and they took down the US Bank building in downtown LA for $440 million, I believe. Pre-pandemic, that was appraised at maybe 600 and something $1 million. So they are so deep pocketed when they see a crisis in the street, they have the dollars to go in and cherry pick assets. So they took that asset down, and that was their first foray into the downtown LA market. So you stick with the deep pocketed players who have years of experience, decades of experience of bringing assets to market pre opportunity zone legislation. The opportunity zone legislation came about, and it was just like, oh, we know how to do this already. We've been doing it all along. We just didn't have the opportunity zone legislation to get full tax exemption on a decade of holding an asset, and now they do. So that's how I would look to kind of check the box, if you will, if I'm looking at a player.
Would you say that most of the that this opportunity zone is almost like to encourage development of properties, like meaning like because you have to buy it and then invest the same amount into development of it, it's almost like a perfect situation for somebody looking to knock down a building and build like a higher density units or make something substantially a lot better, basically.
Exactly. And that's the crux of the
Got it.
law, really, to go in and take old properties down and build new structures up and just create what was once blighted into a very attractive area, making it a destination spot like on the weekends. A decade or more ago, downtown LA was not LA Live. Now it's LA Live, and you go there, you see a movie, you see a show, and you go to a game and you go and eat. So it's a destination spot. It's like other destination spots around the city. It wasn't before, and now it is. And you'll see Inglewood become that outside of the football games and the basketball games and the concerts. That whole area within SoFi is becoming an area where you're going to go see the movies or go to the smaller YouTube theaters and have something to eat before the games and so on. So they make this legislation creates that scenario where once a place that was once blighted and no one wanted to go on the weekends, now people are there and spending money and revitalizing the local economy and so forth.
Are those all areas that you described opportunity zones?
Yes, Inglewood was a massive opportunity zone, and downtown LA was a massive opportunity zone as well. Because remember, the law was passed in 2017 based on 2010 census. So picture 2010 census, and you can see
Hmm.
how a lot of these areas were indeed marked out as opportunity zones. And so those assets that are there now was basically encouraged by the legislation, and more of this is happening around the city.
Can you invest money from a self-directed IRA in an opportunity zone fund?
You probably could. I'm not sure the nuances there. Some funds might allow it, some might not. Um, but the thing about an IRA, you already have tax deferral. And it would be best to have money that's taxable, meaning that I have $1 over here in a CD or in a stock. Every time I make a gain or sell some of that, I pay 30, 40 cents in taxes on it. I have that same stock inside of my IRA, which is sheltered. If I sell my Apple stock, it's no big deal. I just sold it under
Yeah.
the umbrella of the IRA, so it's not a taxable event. It's only a taxable event years down the road when I take income out. But I can sell my Apple stock under the umbrella of the IRA and don't realize a taxable hit. So it doesn't benefit you. Now that I think
To do
about it,
that.
you can't, because in an IRA, you don't realize a gain on a transaction,
Yeah.
whereas
So
outside of
would
an
it?
IRA, you realize a gain. So only gains, capital gains, can be utilized for opportunity zone transactions. It can't just be monies laying around in money market, in CDs and such.
Got it. Okay. And then let's say somebody did not want to do this through a fund. How can they go about finding an opportunity zone?
So
Like
believe it or
just
not,
Google opportunity
this
zone?
information is all public. You can go online and Google opportunity zones in XYZ community or in Chicago or whatever, and you'll see a map comes up and it shows you. And a lot of times when you're looking at properties, it will say this property is in an opportunity zone fund, or not a fund, but in an opportunity zone in general.
Hmm.
I see that all the time when I'm looking at a real a client's multifamily asset, and it says within the description of that location, this property lies in an opportunity zone. Right now, there's a client in escrow with a property in the Inglewood area, and right below that it says opportunity zone area. So definitely you can find online the areas. If you're interested, look at the zip code, and online it will tell you what's in an opportunity zone or not, because it's all public information out there.
I love it. Okay. Anything else that you think our viewers should know about opportunity zones or opportunity funds that would be helpful?
The thing is, just know that it's there. So if you did have a situation where you wanted some tax relief or put money to work that can grow potentially tax exempt, and you missed an escrow or you fell out of escrow, or you have a friend who sold intellectual property or business and now they're getting a windfall but would like to shelter some of that, then an opportunity zone, the opportunity zone legislation can be helpful for that person to continue to grow wealth without Uncle Sam taking 40 cents on the dollar every time you make a transaction. So just know that it's there, because someone might say, gee, I don't need that now or whatever. But then as you continue to, in your circles, you're speaking to someone, you find out they sold their business or they sold their primary residence and they have a windfall. They have grandkids and young adult kids, and they'd like to estate plan and strategize. The opportunity zone could be an option for a portion of those dollars. And a good thing I forgot, one thing I forgot to point out in the opportunity zone legislation, it allows you to keep your cost basis. So, for example, if someone bought a property for $1 million and then years later it's worth 5 million, the million that they paid for it is in can stay in your bank account and no tax liability there. Whereas a 1031, if you do a DST 1031 and that transact and you retain that million, the IRS doesn't allow you to say, well, I paid $1 million for it, I should retain that because it was my cost basis. No, it's kind of prorated because your cost basis, some of it went into the 1031 DST portfolio. So they're not going to allow you to just claim that million as exempt from taxes. Whereas in the opportunity zone transaction, you can keep your cost basis and not have to pay one dime because it is your cost basis, and only capital gains can go into the opportunity zone fund and not have any taxable um, and not have, and you don't have to retain that to participate.
Got it. So you can actually keep the cost base. So like let's say you purchase a property at $1 million, or you, a property at $1 million, you sell for $2 million, you can keep the $1 million and basically invest the $1 million in gain. Then the $1 million in gain will be due in 2026, the taxes on that, and then that $1 million, whatever's left, can grow tax free for the next 10 years, basically.
Exactly,
Pretty
exactly.
good.
Because the opportunity
That's
zone
actually a good difference.
legislation only allows you to put gains into the opportunity zone and not any other dollars. So it's just the gains you're looking to put aside.
Got it. So, Lyndon, I want to just obviously let our viewers know, because a lot of our viewers are selling properties and a lot of them are getting a little bit older in age, and they're like, okay, like I want to sell, but I want to reduce my tax liability. If somebody's in a situation like that, you know about so many different ways of doing that. Like obviously opportunity zones, Delaware statutory trust. I think you talked about a structured settlement as well too, which maybe in the future we can do an episode. How can people get a hold of you if somebody is considering selling their property and they want to talk about like minimizing their tax liability?
Certainly. At 310-283-4147. I'm in Los Angeles, in the Woodland Hills area. And I used to be in West LA and we moved offices. So I can get a hold of, if you don't reach me, you leave a message, I would certainly be happy to return that call and share an email with you with just some educational material, and then have a Q&A with you in person or on the phone or via Zoom.
Fantastic. Okay, Lyndon, well, I want to say thank you for taking the time to be on the show. For our viewers, we had Lyndon Gray with Atria Wealth Management. We talked about opportunity zones. We talked about how to find them, the benefits, different situations where it's helpful. Talked about different due diligence and tax benefits. If you've enjoyed it, hit that subscribe button. If you feel that it'll be helpful, make sure to hit that share button. Thanks again, Lyndon. I appreciate
Thank
your
you.
time. And to our viewers, until next time.